Hey, what it do, world? Welcome to Market Banter. I say this every week that we have the perfect guests for the perfect week, but this week we've outdone ourselves. We have, I think, two of the best guests that any show has anywhere in the world. I am joined today by Sylvia Jablonski, friend of the Market Banter program. She is the Chief Investment Officer and co-founder of Defiance ETFs. And I have with me Mark Hamrick. He is the Washington Bureau Chief and Senior Economic Analyst at Bankrate.com. Sylvia, Mark, thank you both and for joining us on Market Banter.
Thank you so much. Good thing I'm strapped to my chair. I'd fall over. That was wonderful.
Now, I was going to say thank you and welcome, and I should have, but I got a little tongue-tied there because I'm just so excited about having you guys both on. It's a crazy world right now out there. Everything was bad, just 2 months ago, and now everything's great. IMF ratcheting up its global growth expectations. Everyone seems to be ratcheting up expectations. Mark, I want to start with you. What are you hearing and what are you seeing about, we've heard from the economists, the asset managers, all those folks. What about regular people? Are regular people, small business owners, Joe Lunchbox? Are people getting excited right now about the economic environment?
Yeah, thanks for having me, and it really is an honor and a joy, and I apologize for stepping on Sylvia's words there. That's one of the disadvantages of not working in person in a studio where you can take literal cues from people who are not just 2D, so I apologize for that. I'll not let it happen again. To your question, I do feel like I probably am more attached to people who are struggling than many, simply because of my humble beginnings. My parents came from Appalachia, grew up in southeast Kansas that really has not partaken in the economic recovery for decades, and I've been in Washington, D.C., which is the outlier for decades more. But to your point, this was an economic downturn like none other, right, because of the cause and also the depth of it, but the duration, in that it will likely have been quite short, will also be quite remarkable. Some people think the recession ended in January. We're now, as we speak, in April. And so that, I apologize for the cliche, but that rising tide is lifting many boats. It will not lift all boats, but when we've had trillions of dollars in federal spending thrown at the economy, payments that are still flowing in individuals' bank accounts, there are some problems finding ways to pay them because of the unbanked. That's another problem. But I do think that many people are ready to let it rip with respect to spending. And, we think about this so-called K-shaped recovery, the fact that this has been a downturn blending haves and have-nots. Those of us who've been fortunate to work from home uninterrupted using technology like this, we've been among the blessed. We are among the blessed. And there are people who needed to be on the front lines. Many of them lost their jobs, and maybe some of those are returning to work. But I do think the prospects are continuing to brighten. And to sum it up, I think that the trajectory for the U.S. economy is only rising. And if anything, I think in the coming weeks and months, we will be perhaps pleasantly surprised by the strength of this recovery that is taking shape.
And Sylvia, I want to go to you on a similar point, because one thing that I've been seeing and reading about is that more people are putting their money into the stock market than ever before. A lot of times previously you'd see folks putting that money into savings accounts or, doing this or that. And now you're seeing so much more going into the stock market, so much more participation by retail investors. Are you seeing that environment, and what's your take on what we're seeing right now?
Yeah, I think Mark gave a great summary as to what's going on in the markets and some of the bullish sentiment that we see in general in the economy, and sort of the post-COVID world where we're getting vaccines in hands. We see people posting on social media, their little flyer of the vaccines that they got. We have epic and unprecedented fiscal and monetary policy and stimulus in the markets, and so when you see that type of information and you think back to March, and if you as an investor, particularly a retail investor, weren't in the market, you might be kicking yourself a little bit, right? If you look at sort of the snapshot in time, as Mark said, it's been probably one of the quickest recoveries, to the tune of 70% from the low to the high, a little bit higher depending on the day that you look at it. And it's hard to think about where you would get those types of returns elsewhere. So now, of course, you had to be really smart to play it, exactly that way. But if you look at the market over the last few months, or even just year to date, there have been a lot of opportunities. And I think that the retail investor has, one thing, I think the retail population has grown with all of us sitting at home watching TV.
Yeah, absolutely.
There's been this entrance of super young traders, for example, the Robinhood crowd, the sub-millennial, Gen Z crowd, teenagers in high school starting to trade their accounts and getting this, just great amount of interest in the market. And, so I think that coupled with, sort of other people, savings rates are at all-time highs. You're not really getting any kind of money from fixed income for the most part. The market has been the place to be. And if you just kind of, even if you don't know a whole lot about it, and you just think to yourself, everything's been closed. People haven't gone anywhere. They haven't gotten on a plane. They haven't gone to a restaurant. They haven't stayed at a hotel. They are probably going to continue to use technology, and there are opportunities to invest there. So I think that has driven a lot of interest in the retail space to get into the markets.
But yeah, Sylvia, you talk about it, and that seemed to be the kind of retail trade that was driving the NASDAQ higher as we moved about a year ago, back to from those huge, or that huge drop that we saw in March, I think 33% down, to again pulling back to record highs. And what's been interesting over the past couple months, really so far this year, has been the rise of interest rates. And Mark, I want to come back to you on this, because one thing that we're seeing more and more is more people worried about inflation. I just wrote a story this morning about a new survey out that shows that 17% of small business owners that they surveyed out of 10,000 say that inflation is now their top concern, pushing coronavirus pandemic out of the top spot. 17 doesn't seem that high until you realize that in February it was 9% and in November it was 6%. And now we've gotten to this point where small business owners are really starting to get concerned. Everyday Americans are really starting to get concerned. Mark, I asked you, should they be?
Yeah, it's a good question, and I wish I had read the piece before you asked me the question.
I wish you had too, man. My newsletter is out every morning, baby. What are you doing?
Guilty.
The Axios Markets newsletter. You're not a subscriber, Mark? I feel like that's your fault.
No, I am. But I didn't get to it today, so I apologize.
Oh, man.
But it just so happens that we published a survey at Bankrate.com today called Market Mavens, which is our quarterly professional investor survey, and basically they don't look for a huge rise in the yield of the 10-year treasury, only about, I'd say, 20-25 basis points over the next 12 months. But to your question about the entrepreneurs or the operators of enterprises, listen, they're relieved to be able to push inflation to the top of their worry list. It's a little like having been released from the hospital and you're thinking that maybe you should go on a diet at this point, right? In other words, you're thinking, how can I just optimize my operations right now? And yeah, I think that inflation is something to worry about, but that is different than saying I'm going to get hit by this truck that is inflation. And we know that the Federal Reserve, and I know that sort of then brings upon me a cacophony of loud voices just uttering the words. But, the Federal Reserve is basically saying, trust us. And in a way, you do have to kind of trust them by the way they got us out of the worst of the economic downturn a year ago. But our priority right now is getting us back to maximum employment and probably then some. And typically, as we know, they define that at about 3.5% unemployment. But they're not just looking at that broad metric, they're looking at pockets that are not part of that 3.5%.
Yeah.
But the other part of that is, I think, almost more important, and that is, and often overlooked. If you don't think the Federal Reserve is going to react if they see what they take to be sustainable inflation, you're wrong, because that's still part of their dual mandate. But what they're saying is they don't see as strong a correlation between a strong job market, rising wages, and inflation, as was traditionally the case. And that was one of the lessons that was reinforced by when we had 3.5% unemployment last time around.
Yeah, and they've really beat the market over the head with that message saying that they don't see inflation coming. But I wonder if maybe they're missing something. If maybe as they're so focused in on CPI and PCE, that as all these small business owners are saying costs are rising for us, as ISM and IHS Market and even their local economic surveys are showing that prices paid are the highest they've been either on record or going back to 2008, that maybe they're missing something, that people are saying.
Well, if you're asking me that question, I think what they're saying is we know what's happening, but we have a high degree of faith that it's going to last only about 6 months or so, and that these supply chain issues will not be forever lasting. And that is to some degree an act of faith, right? Central banking faith, which is a special kind of agnosticism. But nevertheless,
and surveys show that there's not a whole lot of faith in the Federal Reserve. I think we did a survey at Axios recently that showed I think it was only about 38% trust the Fed to look or do what's in the best interest of them and their family. Sylvia, I want to go to you. In this investing environment, I think things have changed a bit as interest rates have really backed up from where we were even as recently as November, December now, with this just surge higher in the 10-year. What does that do to the environment for equities? Because I think, a lot of folks just were throwing their money into tech or in the NASDAQ 100 and letting it sit, and you could do really well with that. Is that still the case right now? Do you think that trade comes back, or do people need to really reassess and reevaluate at this point?
Yeah, it's a great question. And I think, what tends to happen with the markets and particularly, this year's market, which, so much of the activity in the market has been driven by outside, let's say, emotional causes than necessarily economic factors or fundamentals, GameStop being a good example. But what happened was, we saw that first day that the 10-year sort of shot up, right? And there was this panic and all the tech stocks started to sort of, have these like mini crashes, at least from their highs. And you saw this big rotation into cyclicals and value. And, if you turn on sort of the television on any given day, it was all about, you have to reallocate your portfolio. And, while I agree with the barbell approach and a bifurcated portfolio, I think that what happened was it almost went too far the other way, where we started to, or a lot of investors anyway, started to ignore the fact that Apple falling, 18% off of its high on a particular day was a great buying opportunity. Apple has great services. Maybe they go into EV, the cell phone sales are strong. Maybe they're not going to grow at the same, sort of velocity that they have over the years. But, if you look at those top FANG names, I mean, Google, it's one of the top companies for the reopened trade, for travel, for advertising. Facebook continues to grow because of Instagram. I think when those names kind of got knocked off, and cyclical started to look a little bit high. Like if you look at the hotels and casinos, for example, it's sort of like spot checked a few of them. Some of them are back to their all-time highs.
Right.
Whereas Apple, Microsoft, and Amazon are not. So I guess the message for me there is I don't think that the 10-year being, at the level it's at now, or, even if it bumps up to 2% is actually that huge of a deal for some of these high-quality, cash-rich tech names. You have to pick your spots, though. I don't think that Zoom is the same thing as Google and Microsoft right now, because while I think that company will continue to do well and be important, I don't think we're going to be completely reliant on that type of technology. So it could grow, but again, the momentum will probably simmer down a little bit.
Right.
So
maybe not at the same rate.
Yeah, and I definitely think it's just the message is sort of now really resounding. Like over the last decade, growth in tech was the place to be without a doubt, and now diversification really paid off. If you sort of did it and continue to do it. So I don't think tech is over. I think pick your spots, buy on the dips, but look to diversify too.
BTFD never dies, is what you're saying, Sylvia.
Right. Exactly.
I gotcha. Mark, I want to take it to you because the other major topic of discussion has been President Biden looking to raise corporate income taxes and the Biden infrastructure bill. Those are two big kind of marquee themes, I think, that the market is talking about. And You had Amazon CEO Jeff Bezos coming out and saying he supported both of those initiatives, which I think was big, especially given that Amazon has paid basically zero in taxes for a very long time. What were your thoughts about how this corporate income tax could impact both the market and the economy, and just generally the discussion about that?
Well, let me back away from attacking that part of the question first to try to level set a little bit in terms of why this is an important conversation, and I underscore conversation as opposed to a debate. And that is that, obviously, as we said earlier, and everybody knows, there's been so much thrown at the short-term challenges of the economy, or what one might view as the cyclical aspects. But yet, if you look out over the horizon, the assumption is for the U.S. economy, growth is stuck at about 1.8% in the long term, which I would say is at some level unacceptable. It certainly doesn't help us to accomplish the goals that we want to achieve or need to achieve over the long term, including because we now have these much larger federal deficits and debt. So I think it's a laudable goal to try to bake into the system better performance for the long-term growth prospects of the U.S. economy, and also in the context of an aging population, myself included. So in terms of how you
all
pay
of us
for it,
we're all getting older.
Well, thank God, right? But did I say
that
in
the
this morning
alternative
when I woke up? I think I did. But anyway, I think we can still have strong performance of the U.S. economy if corporate taxes get back to the middle range of where they've been historically, which is what the administration is proposing. But don't forget, Biden is something of akin to LBJ or Clinton-esque in his apparent desire to try to negotiate. Leaving aside this whole how many votes do you actually need to get it through the Senate discussion. But I do think it's a very appropriate discussion to have about what are we going to do when we realize 6% growth, if that's what we get, doesn't continue after 2021, which is a very likely prospect. And that is when markets start to worry.
Absolutely. And yes, Sylvia, I want to shift a bit to you, because one thing that President Biden has talked about is sustainability investments and investing in clean, renewable tech and things like that. But we are seeing, there was this huge run-up in some of these clean energy ETFs, specifically ICLN, and that is really, along with the tech trade, kind of trailed off here as we've gotten into 2021. What are your thoughts about that trade and about just the impact and the outlook for investments in that sustainability, that green tech sector going forward?
So I think it's interesting because I think that these are now more tangible investments than they ever were before. President Biden is very much committed to clean energy, signing the agreement to be carbon neutral along with the EU, China, South Korea, and whatnot by 2050. So there's going to be this huge focus on alternative energy. Hydrogen is a source of energy. The hydrogen market now has about $150 billion worth of investment in it, and it's set to be by 2050, 11 trillion. I think Bank of America put out that statistic, and that's just phenomenal. And you actually see that money starting to pour in now. The Saudis wrote the $700 million check. The EU is talking about $1 billion. You're seeing these hundreds of millions actually start to go into hydrogen research. So that tells me that for the first time, like some of these companies, Plug Power, ITM, fuel, they've been around forever. But now they're actually getting these big investments, and the stations are opening up, and the amount of, hydrogen-based cars and EVs and all these things are starting to prop up. So I think it's happening. I think that it's the trade of a decade. I do think it's the next generation of energy that we're looking at. 90% of our energy comes from fossil fuels. We know they're bad for the environment. We know that the population's growing.
But Sylvia, I want to push back a little bit though, because you say that the trade of a generation, and I think what's happened though in the past few months though is that trade has really been questioned because the returns have gone away. It was just kind of this straight graph up and to the right for the end of 2020. Are you saying long term you are still bullish on this trade, that it's going to come back?
Yeah, we have this culture of instant gratification now. Like I was so upset that Bitcoin is down to 56,000. It was at 60,000 last week, and now I'm like $4,000 more poor. I mean, we have this strange level of psychology now where we expect instant gratification. I think that these are stocks that are poised to do really well over time. And over time is, for me, I think years from now. But I do think that the investments are actually going in, so it's becoming more tangible. Whereas before, it was sort of like a really good idea and something to think about. Now they're actually building hydrogen stations. So I do think that these investments are coming to fruition. I think it's a great place to look. To me, if you tell me that something has $100 million worth of investment and it's growing so much that globally, to go carbon neutral, the world is going to pour in and agree to pour in 11 trillion. There's got to be something to look at there. So I do think that there's a lot of interest in it, and if that becomes something practical. I was reading a lot about, I keep talking about hydrogen, but I was reading a lot about hydrogen as an energy source, right? So the process of electrolysis to actually generate hydrogen, the emission of that is water, right? And water is obviously not bad for the environment, and there's enough hydrogen to take place of 90% of the fossil fuels. So if all of this happens and the technology catches up and it becomes cheaper to do all of this, I mean, it's definitely a potential investment opportunity to look at, I think.
All right. And Mark, I want to turn it back to you as we kind of wind things down here. As you're looking at the back half, as it seems crazy, but we're starting to approach the second half of 2021. What's the biggest theme that you're hearing or seeing from investors that you talk to or economists in terms of this is really the big thing for the back half of 2021?
Well, I'll take it back to our Market Maven survey where most of them, for example, do value, or I should say, are placing a higher priority on value over growth over the next 12 months. And they basically have been on that theme now that this will, I think, be the third straight quarter. So that's an interesting thing to think about. But, I do want to come back to, let's say, a bank rate mantra, so to speak. And that is that our surveys traditionally, and I'm trying to talk about this in terms of financial goals for members of the audience, no matter what age they're in or what their situation's in, assuming they have some financial capability or employed and have assets to work with. Traditionally, our surveys have universally found that the number one financial regret on the part of Americans is the failure to save for emergencies and the failure to save for retirement. So to that long-term investing opportunity that Sylvia is talking about, however investors view those opportunities that are out there, they're absolutely necessary. And so when we saw that the younger cohorts in our economy suffered more during this most recent economic downturn, that's only going to put more pressure on them, along with other people, to save for emergencies for whatever the next problem is, along with making sure that they're well taken care of when the time comes to stop work. In terms of the economy, I just think right now people are trying to catch up with assessing what the actual strength of the economy is, because it seems as if almost every economic report we get is an upside surprise. And if anything, as you know, we're seeing some growing pains with the reopening, whether it's supply constraints, not enough chips to build this, that, and the other thing, including automobiles. And so this is, in a way, when we were talking earlier about the concern on the part of business operators worrying about inflation, these are good problems to have in a world where we're never shy of any problems at all, right? So we'd rather have these issues to work through than the ones we had a year ago, and we're certainly hoping we can stay clear of variance and that kind of thing.
Yeah, I think we'd rather have any problems than the problems we had a year ago. Those were bad problems. Sylvia, we'll kick it to you to close out the show. As you look out into 2021, you've talked about those hydrogen and those clean energy investments. In terms of just the broader environment, though, what's exciting you about the back half of 2021, and what's maybe something that folks aren't talking enough about that you're seeing as a potential opportunity?
The fourth industrial revolution, the idea of machine learning, quantum computing.
Are folks not talking about that
5G?
Enough? I feel like I've been hearing about that.
I think they're talking about it, but particularly, again, going back to the 2.3 trillion of infrastructure, a big focus of that is going to be to develop out further develop 5G and the 5G network. As Mark mentioned, right now we have a chip shortage with the vehicles and things like that, but chips also touch machine learning, Internet of Things, cloud computing, big data processing. So I think the names of the future will be the chips, the semiconductors, sort of all of these companies that are going into the R&D of how we process big data, how we communicate more efficiently on a global level, share information, there's a group called Harden AI, for example. I just happen to know it through my husband. They're using machine learning to connect cardiology research from every global cardiology education center in the world, and they need quantum computers to do it, which don't exist yet. So I think things like this are going to change the way we live. It touches healthcare, it touches retail, it touches 5G, our cell phones. So I think that general space is interesting.
All right. Well, I'm going to leave it there. Sylvia Jablonski, Chief Investment Officer and co-founder of Defiance ETFs, and Mark Hamrick, Washington Bureau Chief and Senior Economic Analyst for Bankrate.com. Thank you guys both for joining me on Market Banter. This was great.
Thanks so much.
Thank you. Pleasure.